Welcome back. Ever since the GST rate cut has been announced, or the possibility of that has happened, we here on CNBC-TV18 have been tracking the consumer space very, very closely. So we're now, looking at it as the consumption centimeter as we build towards the actual activity of, the cuts of the GST rates. That happens on September 22nd. And ahead of that, Goldman Sachs has written a very nice note on the sector post-GST rate cut, indicating that companies across the board may have anywhere between as low as 100 basis points to a 1,200 basis points reduction in their blended GST rate cuts across their coverage. And then there is that, table that comes up for you on the screen, which lists company and their GST rate cut impact and the potential EPS upgrade that comes in over the next couple of years as well. So that table comes up for you on the screen. The author of the table, Arnab Mitra, who is the India consumer analyst at Goldman Sachs, joins in as well. Thanks a lot, Arnab, for joining in. It's a wonderful note, that you've put out. You expect disruption in the second quarter. You expect volume growth to return in the second half of this year. The question is, how do you expect companies to pass on these cuts across the portfolio, and by when? Because if it's just price changes on the MRP, new packages come by. But large part of the market, you and I know, is, the price point market. And we've had managements tell us that grammage changes are a lot more difficult to pass on than just price changes. So when is the earliest you expect these grammage changes to come to the street by? And how do you expect the companies to pass them on at the earliest?
Yeah, thanks, Manglam, and thanks for having me on the show. I think one of the big differences between the GST rate cuts this time and what happened 10 years back in 2017 is that while the government has said that companies should pass it on to consumers, and I think companies are committed to pass it on to consumers, there is no strict anti-profiteering law like there was 10 years back. As per the 2017 anti-profiteering law, companies were required to pass on price cuts in every single SKU or pack that they sell across their portfolio, compared to this time where we feel there's a lot more flexibility. So ultimately, companies will pass it on, but the manner in which they do it across their category may be a little bit more flexible than in the past. So what we expect is the price corrections will land in the market, as you rightly said, after 22nd of September. We'll start seeing new MRP stock in the market. Of course, there is always a transition issue with higher MRP stock already lying with distributors and retail, which is where there could be a little bit of a pipelining issue towards the end of this quarter, which will be a short-term impact reverse in the October month. The grammage cuts, our view is for different categories differs, but could take a month and a half because of the changes that the calibration of factories have to happen. But around November, we should be fully seeing the new MRP stock plus the higher grammage stocks across categories land up. And that's when we will start seeing the impact on volume growth, revenue growth, earnings growth for these companies to flow through.
And what's your estimate on the volume growth in the second half of this year? Once you believe that, it'll come by, how much incremental volumes are you expecting? Let's put it that way.
Yeah. So if you look at how volumes will get impacted in the category, there are basically 3-4 main drivers. One is price point packs. In price point packs, when the grammage increases in a certain 1 rupee sachet of shampoo or a 10 rupee packet of biscuits, it gives you straight away higher volume growth because the consumer will end up consuming a single serve pack or a single biscuit, even if it is slightly bigger in size. The second is there is this unbranded to branded transition, which can happen in categories where there is some unbranded share. Third, actually very importantly, is premiumization. I was going back to my notes of 2017-18, and one of the biggest catalysts of GST cuts that time was premiumization. So as prices came down, consumers were able to move to a higher brand. Companies also very smartly sometimes can use recruiter packs of big brands or premium brands and drop the prices even more than the larger packs, which leads consumers to upgrade. And the last is there is some demand elasticity of price elasticity of demand. So I would expect anywhere between, depending on each company, but let's say if there's a category where GST has got cut from 18 to 5, I would expect anywhere between a 3 to 5% increase in volume growth of that category. However, then we have to account for the fact that everything has not dropped for each company. The portfolio could be different, but that's the broad range of outcomes which we have built in this estimate that you've shown here.
Sure. Arnab, just wanted to drill down to stocks specifically because you are estimating that Nestle, Britannia, as well as, say, the likes of Dabur and Emami are probably going to see the maximum upside in terms of EPS, 5 to 10%. Incrementally, what would be the impact in terms of earnings for them? Would this sustain according to you, going forward, going into probably the next fiscal? And how are you placed specifically on these stocks in terms of a rating?
Yeah, I think one of the things that makes us quite positive on the sector is that we were already getting positive on mass consumption before the GST rate cuts happened. So we put out a report about a month back talking about a mass consumption revival, which was coming out of the lower food inflation, the government stimulus from the state governments, income tax cut, all the other catalysts. GST actually is the biggest of the lot in the series in terms of the absolute size, the impact it can create. So one is the reason why we feel this is not a one-off bump, but actually probably catalyzes the recovery because there were other catalysts also. Because sometimes, when things are already deteriorating and you get a cut or a stimulus, it doesn't immediately help. But when you're already improving and there are other catalysts, it becomes a lot more potent. So I would expect some of these gains to actually sustain. It could be the catalyzation of overall consumption recovery for mass consumption, which has been weak for many years. Now, on a company-by-company impact, of course, I can't talk about specific stocks here, but the reason why we looked at earnings potential upside is that we also don't know whether companies will use it to increase EPS in the first year, or do they want to invest it back to further accelerate volume growth? Like a company could have a choice of delivering a certain volume growth and a certain EPS growth, or may choose to invest back and improve the volume growth even further. But if we look at 2 years out or 1 year out, I think this is definitely a permanent benefit. It resets the growth trajectory and the earnings trajectory of these companies, which has been very weak in the past. What we've shown in that analysis is how much is the potential upside if the company were to retain some of these benefits. And then, of course, it's their choice, which we will hear over the next 3-4 months from companies on how they should pass it on.
Arnab, what about Colgate or toothpaste companies, right? Single category companies. You're highlighting about that. The concern comes in on input tax credit over there. So what would that impact be? And are there any such other categories that one should watch out for? Maybe where we could see a bit more of an impact on the negative side.
Yeah, I think any company which is a single category company and where the GST has dropped from 18 to 5 and where input tax credit was more than 5 in the past will have this challenge. This also very interestingly opens up a differentiation between companies. So let's say there's a company which has one single category and gets a GST cut versus a company which has many categories and gets a GST cut. There is possibility to offset the input tax credit against other categories that they sell. But in single category companies, it becomes a standard GST. Their ability to cut prices is lesser than the competitors who have broader based categories. And we also don't have clarity whether the government will have some mechanism to refund input tax credit. We will have clarity over the next few months. So there could be some challenges there. The other thing we've highlighted in the note is the state government incentives. So many companies have set up factories in states where they used to get a refund of the state GST. Now what's happened is just mathematically the state GST is dropping from 9% to 2.5% in many categories. So the component of refund goes down, which is actually a core part of their pricing strategy today. So we will have to just watch out for these two specific impacts, which is input tax credit and state incentives, which again will differ a little company to company. The more broad-based the company, I think the better chances of mitigating these factors.
Just a final question before we let you go. Arnab, you said that this will catalyze volume growth more than all the other announcements that have come by in the past. But, from an underlying macro trend, from what happened when the GST 1 was announced versus GST 2.0, we have the D2C companies, which are eating into the shares of these companies from the premium end. The prospect of unorganized to organized, we've seen that a large part of that shift take place in the last 5 to 6 years already. So that headroom also perhaps may not be as much. And between the first time it was announced to now, the valuation multiples of these stocks have also gone higher, while the growth has only come lower. So do you think this announcement will only just be a temporary booster, or glory days of large cap traditional incumbent FMCG companies is ahead of us rather than behind us?
I think you make a lot of very good points. I think the starting point of valuations is higher, so we cannot expect, the kind of upside we saw 10 years back in some of these stocks. But on the other two elements, like let's say D2C companies or digital companies, that's a factor very specific to the beauty category. We've not seen too much of that in many other segments. In other segments, actually, the other challenge has been regional players and local players who have gotten stronger over the years. There, we also feel macro played a role. I mean, when the consumption demand is so low, when your real rural wage is not growing at all for year after year, the consumer was trying to lower the household budget. And there was an active downtrading in many categories. Tea, for example, is a good example where actually downtrading to loose tea had happened. Now, as the GST rate cuts come through, your affordability increases, your gap with unorganized sector further reduces. I think the chances are that some of these trends will also reverse. So we don't expect it to go back to the glory days of 2000, let's say 8 to 12, but significantly better than the last 5 years, which has been really anemic growth for the sector. But it should be a significant change in the trajectory is what we are looking at it. And as I mentioned, it's multiple things. It's not just GST, but GST is the largest of the 4 catalysts that actually have come through. And we think the street is probably slightly underestimating the impact. In our conversations, there's a lot of skepticism whether this can really be a big catalyst, but I feel bottom up, it looks like a much bigger factor than any of the other catalysts we've seen in the past.
All right, Arnab, thank you so much for joining in and giving us your views. Always a pleasure speaking with you. We'll keep our conversations more frequent, and we'll obviously keep getting a dipstick on what's taking place on the ground from your good offices as well every once in a while. Take a short break, come back, get you more on the markets and a lot of other stock-specific action. Stay with us.